Forecast 2015, it is January. We are at the Berkeley Arts Center. So usually this is buried in the back. I'm going to bring this right up front. And there's a reason, and we'll talk about it in a second. First, this is general information. Okay? This is general information. This is me taking the world of what the economics are telling us in finance and trying to bring it down into a place and kind of presenting it. I'll give you some of my ideas. We'll talk about some other people's ideas. But this is not advice. Like, this is information. Okay? Hopefully some entertainment, but mostly information. And the last thing, any investing involves risk. And we talked here just a second ago how difficult the environment's been the last few years, even though the broad market indices don't suggest that, but the environment has been one of what is going to happen next. Like, we're talking about things that we talked about 5 years ago. Again, I don't know if you saw that the spy ring that was broken up in New York today, Russian spy ring. There's just crazy stuff happening. Okay, so investing involves risk. Fair enough. So the past, the present, the future walk into a bar. It was tense. Oh, okay, it's pretty bad. But I'm pumped. Thank you. I knew I'd get that from somebody. Okay. Every time we do this, we like to do a little warm up. Today we're going to try 3 words that maybe you guys know, maybe you don't. Does anyone know what a listicle is? 2. Someone is an internet aficionado. 2. If you know, I write a lot of blog posts, and if you read how to get a blog post read, it says do it like this. So listicle is like what they suggest. And those of us who read the blog know that we don't do them all that way. Okay. Second one, ransomware. Anyone know what this is?
Yeah.
Exactly. So you guys have heard about this. A hacker hacks into a business computer, locks it up, and says, hey, we'll let you have your data back if you pay us X number of dollars. And you know people actually pay that? I wonder how many of them get their data back. What's to stop the hacker from saying, actually, sorry, how about twice that much, right? Okay, this one maybe. Tweep. Anyone know what a tweep is? No one knows what a tweep is.
Are you a tweep?
Am I a tweep?
Yeah,
I'm a tweep. Tweet plus peeps. Tweep. It's a new language. Does anyone here use Twitter at all? No one uses Twitter. Oh. Okay. Happiness dividend, HapDiv, happiness div. There we go. Follow us. Okay. All right. We're going to talk about where we've been. And there's one slide in here that we're going to spend the most time on in this section because it sort of talks about how do you look at the world of investing right now and make a decision, and what's it mean to make a decision, and what is a benchmark, and we're going to talk about that a little bit. Okay, so everyone knows S&P did really well this last year, not as well as it did the year before. S&P is up 11.5 without dividends, 12.5, 13 with dividends. 10-year Treasury, this is the interest only, 2%. So that's declined. Does that shock anybody? A 10-year Treasury paying you 2% interest? That's insane. That's crazy low. Gold lost money. Emerging markets lost money. Europe was down as well. We'll talk about these things in a sec. Okay. But here we have the S&P, the Nikkei, and the Eurozone. If you pare back any one of these countries and look underneath, these are cap-weighted indices. Does everyone know what cap-weighted means? That means the biggest companies have an outsized effect on what happens to the index itself. So small companies, even though they might all be negative, may not affect other than bringing the big positive down, right? So if you have 20 companies in the S&P that are doing really, really well, which is what we have, it pulls the entire index up, even if everything else is flat. Does that make sense? So in May of this last year, 2014, someone did a study of all the stocks in the S&P and said the bottom half of them were negative. So half the stocks in the S&P negative, the rest of them positive, and the top 50 really positive. So that affects the end result. You just look at, oh, the S&P, it's up 11.5. That's great, but that's not really what's going on in the S&P or the economy. And we know this, especially here when we think about what's going on in the economy. Japan, Eurozone, we'll talk a little bit more on the Eurozone in a second. Okay. America is the cleanest, dirtiest shirt. That analogy has been used for 5 years. Okay, and this is some of the basic data: GDP, unemployment, what's the other one? Inflation. And you can see the United States is the only one where GDP has been solid or is solid. Everyone else is trying to get it to go. And right now we see this euro area inflation right here, this little green one. That's going to go negative very soon because of the oil changes, okay? So then we have deflation, and that may be a problem. And that's something, we've got two camps in economics, one talking about inflation and worried about inflation, and I've been one that's fallen into that camp quite often. Another one worried about deflation. And that camp has been right. So this camp, where I am, wrong. This camp has been right. Until it's not. And that's the thing that scares me more than anything else, okay? So this is the slide I want to spend some more time on. So in the US, everyone benchmarks to the S&P. And if you benchmark to the S&P and you think about, and every question I have in the last 3 months is how are we doing relative to the S&P? And I've got clients, just like they did in 1999 and 1998, just like they did in housing in 2007, 2006, saying, how come we're not more exposed to the S&P 500? And the answer to that is, well, commitment to diversification. Does everyone remember 2009, 2008, 2009? If you look at a 10-year chart of 15 major markets, emerging markets, Europe, real estate, bond markets, broad swath of markets, there's one that's negative for 10 years, and that's the S&P 500, okay? So commitment to diversification is absolutely a critical concept. What's the pain when you commit to diversification? How is that difficult? 2014. That's when it's difficult. That's when you really wish you had been all in on the S&P 500. But this was your real opportunity set right here. That is global equities, 4%. Why? Because everything else was negative. Like the emerging markets were down, Europe is down, everything else is negative. And so if you have a positive outcome, it's because you had a tilt towards the United States. You might have been diversified with a tilt towards the United States. Other than that, you would have had a negative outcome. So in our portfolios, every single one of them, we've been broadly diversified. We've had, I didn't see you come in. We've had all kinds of equity exposure from frontier markets to emerging markets to European markets to US markets with a tilt towards US markets, which means when you benchmark a portfolio, you should look at the total opportunity set, which is this, right? And hopefully, when you have a question about portfolio performance, before you have the question about portfolio performance, this is the benchmark. If it's not, that's the first thing we're going to talk about, okay? The second thing we're going to talk about is how much risk we're going to take, right? So we have a portfolio we call a capital preservation portfolio. It was up less than 1% this year. But the point is, the goal is preservation. And we talked about this earlier, how crazy it is out there. When the markets are really going every which way, and we got some down and some up, you have to have ballast on the sidelines, you have to be careful. And if you're saying, I want my capital preserved, which is what that portfolio is for, in an environment like this, that's the right kind of performance. If you're getting a 5% performance on a capital preservation portfolio, then you do not understand the amount of risk you're taking. Make sense? Questions? Okay. And we get a little bit more detail here. Commodities negative. Real estate incredibly positive. And it's been 4 or 5 years. You know, I talked about 2009, the 10-year window. What was the best performing asset, 2009, for 10 years, leading up to 2009? Real estate. And here it is again. This is interesting to me. This is just, is it always? No, remember 2008? But over time, it seems to do pretty well. But here in the United States, here in the Bay Area, we're overexposed to real estate without having it in our portfolios. Like every one of our houses, if we have anything that we own and the bank doesn't own, that's exposed to real estate. And to add more to the portfolio, we don't really do that in our portfolios. We'll help you and advise you on how to do it directly, because that's actually where the benefits lie. Most of these REITs and things are not the best, anyway. Okay. So we've talked about Fed policy a lot, monetary policy. Here's the options that they have. The simple option is they control interest rates on the short end, the Fed funds rate. They get to tell banks how much they have to set aside in reserves. And then sort of unconventionally, they can buy bonds on the open market. That's quantitative easing, which we stopped in October. And then the thing that they started doing is giving long-term forward guidance. This is we're going to keep rates low for a long time. And then slowly, we're going to keep rates low until we start selling our bonds back into the open market. So they're going to give us slight hints every couple months about how or when they might start ticking interest rates back up. Right now, that's looking at middle of the year, towards the end of the year. Maybe they won't be able to do it at all. These are just the policy tools they have, okay? Those policy tools have led a couple sets of people out there to talk about they have boosted asset prices or they have not boosted asset prices. I fall into the camp of they boosted asset prices. So we've had, if you think about, remember the history is we've had 3.5 quantitative easing setups. After every single quantitative easing, there was a 20% decline until they said, wait a second, we have to do more quantitative easing. And then that ran its course, and then it stopped, and then 20% decline, correction, and then the Fed steps in and says, wait, we're sorry, we didn't mean to end that, and they start another one. They did it 3.5 times. Today, is quantitative easing over? Everyone have an idea? Is quantitative easing over in the United States?
No, I don't think so.
It's not. So the reason that's not over is they've got a $4.5 trillion balance sheet. The interest and the maturities of which they continue to buy new. So they're maintaining their balance sheet. So QE isn't over yet. They're still buying more bonds. They're not buying new bonds. They're not committing new capital, which means they're not printing new money. They've just handed that over to the European Union. But I want to look at this. So I fall in the camp of reduced rates and QE has boosted asset prices. So read just a few of these. So these are the arguments that say that low rates on stocks may not have boosted asset prices. So long-term analysis should recognize low rates are temporary and treat future cash flows accordingly. It's a should and a maybe, and it's a hedged statement. Like, I don't think it's affected it, but maybe people actually don't realize that, so it has affected it, right? If you look down that list, every single one of those is that way, except that last one that says, no, it really could only affect it 1%, which is, I think, absurd. So at the end of the day, there's a lot of argument out there. I actually think there is a boost, which is why when you look in our portfolios, we're using a benchmark of the world index, right? We talked about that. We're also a little risk averse right now. So we're peeling money off of risky areas because of that issue. We've stopped QE. The last time we stopped it, it only dropped 10%. This was October of last year. And in anticipation of that, markets dropped 10. And then jumped right back up. But have been volatile ever since. So what we've seen is actual return of volatility. We haven't seen for 2 years prior to that. Like, we have not seen an actual correction for 3 years now. And now we see zigs and zags. We've seen 8% this way, and 7% this way, and 9% this way. We've seen just real serious volatility. And that's normal in a non-QE environment. So the thing that QE has papered over is volatility. So now we're trying to figure out where asset prices should be. And it's an argument that's not over yet. And that's why I'm sort of risk averse and a little bit concerned. This is another place I was totally wrong here. In fact, everyone except for one man was wrong here. Did anyone know who the guy was who got it right? He's very public. Jeffrey Gundlach, double line. Incredible bond manager. He's the only one on the planet that got this call right. He said early last year that everyone else said, no, rates are going to have to go up now. And he said, no, they're going to keep going down. He says right now that they're going to keep going down. So which eventually he's going to be wrong. I don't know if it's going to be this year or not. We're not positioned to benefit from lowering rates because that's, I think, an insane place to be. 2.2% on a 10-year bond. That's, there's not a lot of upside for it to go down. You're not going to make money. And if it does go the other way, you're going to lose a ton of money. So it's not a place you really want to play. He plays with massive amount of money, but he knows how to hedge and all that kind of stuff, and he's got capital to burn, so good for him. Other things that have happened this year, Russia So 6 months ago, we sat here, and the day I gave the presentation, the halftime report, I had seen in the newspaper, maybe the day before, I'd seen in the newspaper that Russia had started to put surveillance equipment back in Cuba again. And everyone see that when the envoy from the U.S. went to start repairing relationships between U.S. and Cuba, there's an article that said there was a Russian ship parked right there with all kinds of surveillance equipment on it to watch us. And in New York today, they busted a ring of 3 actual on-the-ground spies. Ever seen the movie The American, or the TV show The American? I was like, oh my God, it's real. It's crazy. ISIS, terrible. Has anything really changed? Ebola, almost over for now. Just lots of stuff happening. The Russia thing is the thing that scares me the most. Okay. Volatility. Okay, we'll go to this in a chart. So see this? That is ending QE. So you see massive spikes in volatility. What that is the VIX, and that is the fear gauge. The VIX shot up way over this in 2008. Here, just a little bump. This is the average. We saw a little bump here. Do you know what this bump was for? What were we afraid of at the end of the year, last year? This is the
end of 2014.
interactive part of the presentation. Yes, but there was something specific that was going to happen, or that they were worried might happen.
Yes,
government shutdown. But they just stepped right in and stopped it, right? It was, okay. So that's the anticipation of that, and then, it's okay. But this is the interesting part. When you look back, see this spike? That's the 60 on the VIX, and that's when the S&P does this. And in here you see a spike, and you see the S&P drop, spike, S&P drops. So this is kind of a gauge you can pay attention to. And as it goes up, it's a little bit of a warning signal. It's not flashing anything really bad. It's popped up, but it's just to the average, right?